Hello, fellow dividend investors. Happy Monday. Hopefully, everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So, guys, we're going to go over the overall portfolio performance, the buying power, my individual holdings, and of course, my watch list. So, jumping right in, for today, we are up $300, up about 0.5%. Then we are down $1,600, down 3% for the past week. Then for the 1 month mark, we are down $800, down nearly 2% for the month. Then we're up $1,600, up another 3% for the 3 month mark. Then year to date, we are up $19,000, up nearly 4% year to date. Then for that 1 year mark, we are up $1,800, up about 3.5% for that 1 year mark. And then all time, we are up $16,486.35. And we have a total cumulative return of 46% all time. And the portfolio value, of course, it's going to change because the markets are open. But right now, it's sitting at around $51,800 for today. Guys, we do have a buying power right now of $105.43. And I plan on putting that into Visa stock and possibly another share of Google, depending on where both Realty Income and Coca-Cola are. I might put that back into those stocks as well. It just depends on where prices are at when I get that dividend near the end of the month. So jumping right in, first off, we're going to go with Google stock. We're sitting at $155.92, up nearly $2 today, or 1.3%. We only have one share, so of course that market value is going to reflect the price of $155.90. Then we have an average cost of $155.47. 0.3% of the portfolio is in Google. Today we're up $1.96. Total we're up 45 cents with a 0.3% rate of return as of right now. Now, guys, I do know that Google does not pay a dividend, which I'm fine with. I think that there are very few, but there are a few companies that I'm willing to overlook the dividend due to the quality of the company. And Google, for me, fits that quality. So I will add to Google. Like I said, I want to buy a share of Visa before the end of the month, but I wouldn't be surprised if I start adding pretty heavily to Google because I do want it to be one of my top 5 foundational stocks. In order, I want it to go first, of course, is going to be Apple based on size. Then I want it to be Visa, Coca-Cola. Then I would want it to either be Google or Berkshire, and Google, Berkshire, or Facebook to be in that 4th or 5th position. So they're kind of interchangeable for me, but I do want Google to be in 4, and I would rather have Berkshire in 5, but I wouldn't be surprised if Facebook takes that spot. Then we've got Realty Income sitting at $53.56. It is up about 54 cents today, or 1%. 170 shares, $9,100 worth of market value. Average cost is $65.03. 17.6% of the portfolio is in Realty Income. Today we're up $93, up 1%. Total we're down nearly $2,000, down 17% still, with a dividend coming in on the 15th. So here, I think middle of next week, we should be getting that dividend. And I'm excited because I love that monthly income, that cash flow. That's really what the portfolio is about. So as of right now, I believe it is the stock that is down the furthest. So logically, I should be putting all my money into Realty Income right now. But I do want to just get some Visa in the portfolio and cost down average when it's applicable. So, I mean, logic says I should buy this, but I really do want to add some more Google and Visa. And guys, that's the important part about investing is you get to pick, right? If I really believe that Google is a better growth, has a better growth trajectory than Realty Income, regardless of price, then I should be buying I should be buying Google. But if I really want that cash flow, of course, Google doesn't pay a dividend, so I'm better off to be buying Realty Income. It just depends. So as of right now, I would want to be purchasing a share of Visa, but if it stays at these low levels, I wouldn't mind buying some more Realty Income because as of right now, it is the best deal within the portfolio. Next, we've got Altria sitting at $42.02. We've got 320 shares, $13,000 worth of market value. Average cost is $47.27. 26% of the portfolio is in Altria. Today we're down $121. Total we're down $1,600. We are down 11%. Total on Altria, with a dividend coming in on the 30th of April of $313.60. So with that Realty Income dividend, we will have about $350. So with the money I already have in the account, it should be about $455 to $460. So I'm excited to see that cash flow start compounding, simply because even if I do have a deal like Realty Income, I want to buy more shares. So I want a little bit more cash flow in the portfolio before I jump into stocks currently. Then we've got Coca-Cola, 15 shares, around $900 worth of market value. Average cost is $60.54. 1.7% of the portfolio is in Coca-Cola. Today we're down $3. Total, we are down nearly $19. We are down 2% here on Coca-Cola. So like I said, guys, even though Realty Income is the glaring deal, I still want to add more Coca-Cola. That is a top 5 foundational stock. So I want to add more to that if the stock stays at these depressed levels. So, excuse me, I'm taking a sip of Coca-Cola as I'm making the video. But I'm not opposed to adding any of the positions. Of course, I don't. If they weren't high quality, they wouldn't be in the portfolio. But I do want Coca-Cola to be one of the top positions, so I need to add capital when it makes sense. And right now, it totally makes sense to be adding capital to Coca-Cola because it's down overall. Next, we got Apple, which is down for today, but not enough for me to be purchasing it. It's sitting at $168.83. And I only have one share, so my $168.82, of course, the market value is going to reflect the share count simply because I only have one share. But we have $132.66 for our average cost, up. We're up total today, but we have 0.33% of the portfolio in Apple. Today, we are down 81 cents. Total, we are up $36. We have a total return of 27% on Apple. Now, guys, this is one of those, just like Visa. It's a high-quality company. Doesn't go on sale very often, and I understand that. So part of my cash hoard, the reason why I want to cash hoard a little bit is I want to be able to buy more shares of Apple when it's at a good value, which right now is just below my average cost. So even though Apple has been falling, and I believe it's near that 52-week low, yeah, only a few bucks off that 52-week low, I don't want to purchase it at these prices. So I want it lower than the 52-week low. I understand that's going to take a while, and I'm willing to wait. So Apple is my favorite company. It will be the biggest position in the portfolio, but I want to be able to buy a boatload at a price that is near or below my average cost. So I'm going to be sitting and stacking cash for a while, but I'm okay with that. Then we've got AbbVie at $169.96, 95 shares, $16K worth of market value. Average cost is $95.19. 31% of the portfolio is in AbbVie. Today we are down $380. Total, we're up $7,100 with a near 80% return. By far my best investment. The dividend growth has been awesome, and the price appreciation has pretty much gone straight up since I bought it. Of course, if you look at the, long term, it's been going up and down, but just given my cost basis, I'm up $7,100, so I can't complain. This is one of those that I'm just gonna let it grow, even if I don't add shares to it. I have been getting a lot of questions about why I don't just add 5 shares so I can do options trading on AbbVie. Simple reason is, guys, I don't want to boost my average cost up that much. It's only 5 shares, but it's like nearly doubling my average cost for AbbVie, so I'm not interested in doing that right now. I'm going to let it grow. Even if I don't add shares to this position, I'm still getting a growing dividend, and I can reinvest it if it makes sense, or I can use that $150 to buy a free share of Google every time this pays me, or I could buy a couple shares of Realty or a couple shares of Coca-Cola. So this is just one of those positions that even though I can't add to it right now, it's still helping me grow the portfolio through dividend growth investing. And then next up, we've got T. Rowe Price. T. Rowe is sitting at $118.19. Of course, fluctuation is going to make the price change right as I say that. But we're up $1.56 today. We have 100 shares, almost $12,000 of market value. Average cost is around $110 per share. 22% of the portfolio is in T. Rowe Price. Today we're up $156. Total, we're up over $800. We have a 7.7% total return here on T. Rowe Price. And guys, this is in the same boat as AbbVie. I love T. Rowe Price. All right, I wouldn't mind it being in the top 5 foundational stocks, but the reason I don't put it in that area is because I feel like Apple is a better position. I feel like Visa is overall a better company, but I still want exposure to T. Rowe Price because they are a dividend aristocrat. They have a great payout ratio, and their management is very good at reallocating capital within the business. And so that's why I want it to be one of the bigger positions. Right now, it is a pretty big position. I know some of these positions, guys, looking at, say, I mean, even O is pretty big, 18% of the portfolio, 26% of the portfolio, and then of course we've got 31%, so a third of my money's in AbbVie, and then another, almost 20, say like 25%, so a fourth of my money's in T. Rowe and Altria. So I understand that I do have big positions, but you guys have to understand that this has been, a 5-year journey. So it's not like, it's not like I just poured money into these positions. I put money in when it made sense, and a lot of these positions have grown. Some of them haven't. Like Realty Income has been pretty stagnant, as you guys can see. It's down about 20%. So I'm not winning on all of these positions long term, which is fine. But the companies that I do have a pretty big position in, if they're down, that's good. I can cost down average. So both Realty Income and Altria, that's what I want, is the companies to go down so I can buy more. But then in situations like Apple and AbbVie and T. Rowe Price, I would prefer them to fall more so I can buy more of the quality companies that I love. So I know I get a lot of questions about, you have 25% of your money or 30% of your money in AbbVie. Does that scare you? No, because guys, originally we can look down and kind of see. I can show all real quick. If you look at orders, I don't believe I've ever sold a single share of it, but the bulk of my purchase was 30 shares of AbbVie in 2019, and then of course I bought more. I bought another one at 72, bought 14 more shares, says at 116, then 119, bought a few more 10 shares at 132, and then it says I bought some more 10 shares at 162, but that was with dividend reinvestment. So I've bought, I don't think I've bought any since like 2022, so it's been a while since I've actually purchased anything. But guys, the dividend has grown. You can even see there, like, the 2023 dividend for November was $140, and now it's almost $150. So this is a prime example of buying and holding and why it pays off. And I do want to own more of AbbVie, but I just don't want to keep purchasing. I don't want my average cost to keep going up as high as it is. So I've gotten a lot of questions about how do you sleep so easy at night when you got a third of your money in one position, you got like 25% of your cash in 4 positions, spread out, and that's just because I believe in the companies long term. Some people would struggle with that, but I've gotten used to it. I feel like, if you don't want to pick individual companies, you can pick the S&P 500. There's nothing wrong with that. You make damn good money doing that. If you're a know-nothing investor, which even people who think they know a lot about investing don't beat the S&P anyway. So a lot of times it's better to put money in the S&P. I would just rather get that cash flow from dividends instead of just giving it to the S&P. And I think some of the companies that are down right now, they'll bounce back. Or I can find another situation like an AbbVie and outperform the market. I don't know if I'm going to do it consistently. I doubt it because nobody does. But just for me personally, I would rather pick out companies that I believe in long term instead of just owning 500. Because to be honest with you guys, I probably wouldn't be interested in like 480 of those. Right? Most of those companies, I'm not even going to care. I'm not going to want to own those companies. That's why I do individual stocks. Because as much as as much as Amazon's going to grow, or, like there's Amazon or Tesla, I don't understand those companies very well, right? That's why I don't own them. So I don't want exposure to companies I don't understand, even if it means a higher rate of return. I'm not willing to expose myself to something I don't understand. That's the same reason why I don't own Bitcoin. Like, anybody on the internet can say, oh yeah, Bitcoin's going to go to 10,000 or a million or a bazillion. It doesn't matter. Like, I don't see that as a loss. Like, I'm very much in the camp of Buffett and Munger at Berkshire Hathaway and saying, like, I don't want to own something I don't understand. Because the difference is here, guys. So, like, let's look and see at, say, T. Rowe Price is a perfect example. So T. Rowe Price, we'll go to the 5-year chart. T. Rowe Price is worth over $200, like just over 3 years ago. And, somebody who bought it back then and sold it now, I mean, they sold at a loss, so they're guaranteed to lose money. But if they don't understand the company long term, if they don't look at the economics behind the business and don't understand it long term, of course they're going to lose money. And that's why I pick individual stocks, because I feel like I am able to analyze these businesses. I'm able to hold them and understand why they're going down and capitalize on fear in the market. And that's where good returns come from, is understanding what you own. And there's nothing wrong with buying the S&P 500, but if you don't understand most of those businesses, which I guess you don't need to if you own the S&P, but I'm just saying, like, if you don't understand it, you shouldn't own it. So you could be a Tesla fanboy, but if you don't understand how the company works and how they actually generate profits, you shouldn't own that company. That's why I don't own Nvidia or AMD or Amazon. There's a lot of things that I don't understand, and I'm okay with that. I can accept that. I'm not supposed to understand everything. If I sit in a room with Einstein, I don't know anything about science. I'm not a science fanatic, so I don't know anything about it, and I'm okay with that. I'm just same thing with, if you sit in a room with Buffett, you think you're the greatest stock picker in the world, he's going to tell you to buy the S&P, and you're probably not going to beat it. There's always going to be people who are smarter than you, and it's a true superpower to understand that you can't comprehend something. You don't have to be right about everything. You don't need to know everything. And the investors who win long term are the ones that only buy what they understand. And that's one of the reasons why I love this YouTube channel and making videos, is somebody will call me out. Somebody will be like, you don't understand AMD. Why are you in it? And that's why I wanted to speak on Google real quick, because I do understand Google. I use it every day. I'm on YouTube constantly. I understand ad revenue. I see YouTube ads. People get paid per click, based on the amount of views and watch time that they get on YouTube, and then that makes Google money, and they pay the influencer based upon how much money they made on ads, and then they split it both ways. That's, small, like a small definition of how they make money. They have more avenues, obviously, but mostly it's ad revenue. So I can understand Google. But I do like the transparency, and I think you guys respect that. I show my portfolio, I show my gains and losses. Like, I'm down, over $2,000, say like $2,000 on Realty Income. I don't care. I love being able to share that and be challenged by my viewers as well. And then, of course, the watch list, Visa, just like I said with Google, I use this every day. I literally just bought a Chick-fil-A sandwich, and I'm drinking Coca-Cola. And guess what? I swiped my Visa card. So I used it today, and I'll use it when I pay my heat bill. I'll use it when I pay rent. Use it when I fill up gas. Everything that I purchase is purchased with a Visa card. So I might as well get a piece of that transaction by owning it. I have the same logic with Coca-Cola and the same logic with Apple. I own a Mac. I've had an iPhone. I've had like 3 different iPods in my day. So I understand the transactions and how they make money. And I'm actually reading the Steve Jobs book by Walter Isaacson right now. It's a wonderful read. Steve got a lot of flack from making Apple streamlined, and people thought that they were going to lose a lot of money on it because Microsoft and Windows just worked with everything, so they didn't have exclusivity. They worked with everybody, and Apple said, no, we're not gonna do that. They eventually did work with Microsoft, but starting out he didn't want to, because he thought that Apple was going to benefit better from not working with them. So, it worked and it didn't. It obviously worked for the long term, because they're still around. But I love being able to share my journey, and I want to own things that I use every day, because if I'm using my Visa card, if I'm swiping it every day, odds are millions of other people around the world are probably going to be using a Visa card too. Then, of course, we've got the 2, what I would consider growth stocks, but Berkshire Hathaway, I've talked about this one every video. I love it. I'm going to the Berkshire meeting here in May, I believe. First one without Charlie, so we'll see how that goes. I'm gonna miss him, but I love the business model, guys. They use insurance float and cash flow from their businesses to purchase other businesses. Buffett is literally a dividend growth investor. That's what he's doing. He's using his insurance float, the income from his businesses, and the dividends that he generates from owning public securities, and putting that back into Berkshire Hathaway. and buying new businesses with it. So it just keeps compounding and growing. So Berkshire Hathaway, if you think about it, he uses insurance like I use dividends. So I understand the business. I understand most of the subsidiaries. Berkshire is so big now that it's difficult to get down into the bare bones of it and see every single little subsidiary, because a lot of them don't even move the needle anymore. And that's part of the issue with Berkshire, is that it's so big now that they have to fire at elephants. They don't have the opportunity to buy small companies. I mean, I watch Berkshire meetings all the time, and it was one of the newer ones, but Charlie was saying that, like, we did a, say, $10 billion deal in insurance this year. That's the market cap of some American companies, and for Berkshire, it didn't even move the needle. It wasn't even a drop in the bucket. We wouldn't even notice it on the full wealth of Berkshire and the compounding effect, because it's not a small amount of money, but it's small in comparison to size of Berkshire. Therefore, we told shareholders what we did in insurance, and that was part of it, but we didn't highlight that deal specifically. But just because it's not highlighted doesn't mean that it's not appreciated, and that it doesn't make a difference in the business, because it does. So it's like they are so huge now that it takes really big bets to get noticed in the overall scheme of Berkshire. So I want to own it just because he's doing with insurance what I plan on doing with dividends, and I want a piece of that. Next up, we got Meta. So I've wanted to own Meta for a while. I should have bought it a couple years back when it was at $88 a share. I literally talked to like 6 or 7 people about wanting to buy it, and I was stupid and didn't do it. So that's my own fault. And of course, now they pay a dividend. That's not the glaring reason why I want to purchase Meta. I think it's cool that they pay a dividend, because then you get a little cash flow from the investment, but that's not the main reason why I want to own Facebook. I want to own it because I feel like it has a strong competitive advantage, and they've proven over the past decade that they are able to stay competitive in a social media market, and they're not going to be, overshadowed by some different social media site coming in and taking their users. So I have to wait for another scandal or another stupid, asset allocation mistake by Zuckerberg, and I'm okay with that. I might just purchase a share, and cost on average, like I said, I would with Visa, because I want to own Meta, and I want to own it for the long term. I don't plan on selling it. I have owned shares of Meta in the past when I was 22. I'm 28 now, so I've been investing for about 5 years, and that was one of the first stocks I actually looked into was Facebook, and I owned it, and it was a fractional share, and I sold it because I didn't actually do any, I didn't look into the business at all. So I feel like now I've done a deep dive on it, and I like the company. I like the long-term projection of it, and I think it's a lot like Google. So but with that being said, guys, I just want to say thank you so much. I really do appreciate everybody checking out the videos, being supportive, and leaving me good feedback too. I think I said this on Thursday's update, but some days I don't feel like recording. Some days I don't feel like posting a video, or and I got a positive comment, and it kind of helped me push through that wave of negativity that was going on in my head. So I do appreciate you guys, and it does make a difference in my day, and I hope when I post videos it makes a difference in yours too. But with that being said, guys, remember to hit the like button and hit subscribe, and I'll see you guys tomorrow in another Robinhood portfolio update. Take care, guys.